many people would call drawbacks like higher cost than other solutions, slower transaction settlement times. But to us, those are features, not flaws, because it's part of why it is the safest ecosystem in the crypto asset world. So we don't look at those as issues. We look at them as really they've been built into the ecosystem to assure its success as the safest crypto asset ecosystem.
Cryptocurrency markets, like traditional financial markets, exhibit seasonal patterns influenced by market sentiment, regulatory changes, and technological advancements. However, unlike traditional markets, cryptocurrencies are uniquely impacted by factors such as mining rewards, halving events, and their speculative nature, adding complexity for investors. In this context, Cathie Wood, CEO of ARK Invest, has spoken about Bitcoin and the US regulatory climate, criticizing its influence on innovation and warning that harsh rules drive companies away. She also discussed her approach to market volatility, emphasizing client education and long-term investment perspectives, indicating that she prioritizes clients' requirements and fund performance over her net worth. Cathie Wood remarked that while some people see Bitcoin's higher cost and longer transaction settlement times as limitations, she feels these qualities contribute to its security. She slammed Gary Gensler, the SEC head, for being a menace to the ecosystem and driving innovation out of the United States. Wood stated that this has resulted in some companies refusing to work with US investors owing to regulatory worries. Watch clips from the interview for further insights into Cathie Wood's interview. Please like this video, subscribe to the channel, and turn on post notifications for more content. Enjoy the video.
Do you think there are any other drawbacks to Bitcoin?
Well, many people would call drawbacks like higher cost than other solutions, slower transaction settlement times. But to us, those are features, not flaws, because it's part of why it is the safest ecosystem in the crypto asset world. So we don't look at those as issues. We look at them as really they've been built into the ecosystem to assure its success as the safest crypto asset ecosystem.
And how do you see the regulatory environment changing for Bitcoin or cryptocurrencies in general?
What has happened, the U.S. has been the worst. Gary Gensler, as I've said many times, has been a menace to our ecosystem and has pushed a lot of innovation associated with Bitcoin and other crypto assets into the rest of the world. So much so that many of the innovators who have moved to other parts of the world, whether it's Switzerland or Berlin or London or Hong Kong, Singapore, they will not deal with U.S. investors even. That's how bad it got.
Why? Why?
Because they think they'll be tainted because we are regulated by U.S. regulators.
And why are U.S. regulators so strict? Like more than any other part? You
know, when you're a regulator, there's a lot of power seeking, and we know the history of the SEC and the CFTC. They've butted heads over the years, right? And we saw this during the derivatives, the evolution of derivatives in the 90s. And finally, with, I think, a Supreme Court ruling, they both regulate it, but regulate different parts of it. That is what I think was going on. There's a power struggle in the regulatory ecosystem. This is my purview. And so we may go to the Supreme Court again. I don't know. I think that was the main issue. Now there's something called regulatory arbitrage. And so that's what I mean by other countries very interested in attracting innovation are one-upping us. And I'll give you our first example. When we started ARK in 2014 was drones and the Federal Aviation Administration. So Amazon was on its 9th generation drone back in 2014, and the FAA would not let Amazon fly its own drones on its own property outside. It is only in recent months since that has changed. But in the meantime, one of the companies in our venture fund, Zipline, seems to have ingratiated itself with the regulators, meaning it has, what we've observed is it has taught the regulators, prepared them every step of the way, for what they were attempting to do. No surprises whatsoever. So the FAA did start opening up a couple of years ago to Zipline. Zipline has a pilot going with Walmart in the Dallas, Texas area to deliver parcels. So, and so Zipline beat Amazon to its own game, which is really interesting. So, but this regulatory arbitrage, other countries, so Amazon went to Hong Kong, UK, Australia, India to test out its drones. And then the FAA became a little bit more understanding. I don't know why they didn't give the green light to Amazon sooner, but they did start giving the green light.
Cathie Wood addressed how she handles market volatility, indicating that she focuses on teaching clients about the dangers and potential significant swings in the value of their investments. She pointed out the importance of a 5-year investment horizon and advised clients to adjust their portfolios to maintain a consistent proportion. Cathie Wood also discussed her wealth management strategy, admitting that she has always been a huge saver. Cathie Wood also disclosed she loved investing, which allowed her to take chances and launch her own business without incurring debt. She stated that she does not prioritize her net worth, but rather her clients' requirements and the performance of her investments. Cathie Wood admitted that she has grown accustomed to market changes, but remains committed to her investment strategy and client education. Let's go back to the interview and watch more clips to gain insights from Cathie Wood.
How do you deal with the volatility of the market and seeing such large swings?
Mm-hmm.
Because I'd imagine for you, just like in a single day, it could be up or down, $100 million.
Mm-hmm.
Do you just become desensitized to it at a certain point?
Well, I'm sensitized to it from this point of view. I think about our clients, and I think it's critically important for us to educate our clients. We're not going to be your entire portfolio. And some people in 2020, we were their entire portfolios. And, we were trying to say, no. Now we have papers, we're writing papers. And so we should be a small allocation and understand this is going to be a very volatile part of your portfolio. We're the closest to a venture capital fund in the public markets. We've always said that. And some people have understood that and other people have not understood that. So closest thing to a venture capital fund, we have a 5-year investment time horizon. We hope you do too. And so I do think about our clients. I think that our distributors, our partners, are the important conduits for that message, but we need to be out there more as well. And it's very important for us to say, look, if we've just doubled in a short period of time, you need to take profits. You need to rebalance, right? Because that will give you the psychological wherewithal that when we drop 50%, you will add back to this portfolio, because over time, we should outperform the broad-based markets by a lot from this level. So I think about it from our client's point of view. Are we preparing them enough, whichever part of the market we're in? And we've been in a very tough part of the market, and just convincing people, there's too much of momentum-driven investing. It's really bad. If you're buying high and selling low, I would think that's a very basic tenet that you're trying to teach your audience. Do not buy high and sell low. Think about the other way of doing this. That's a much more productive way of investing. But in terms of day-to-day on the professional side, we've got a 5-year investment time horizon, and we're surfacing evidence, yay or nay, every day. Are these companies harnessing AI as quickly as we thought they would? No, we've made some important sales in this first half of the year because these companies were not. And this is moving very quickly, and they don't understand. You don't have time. If you don't do this, others will. And so this cleansing out period, I think, has been very important for us with this 5-year investment time horizon. So what we do in the short term, when the market's treating all of our stocks in the same way, we will sell one and benefit longer term from tax losses there and buy another stock that is also down and out. It's a mindset. And so I have that base and I can take risks. But that's why when you ask the question, I think about our clients much more when it comes to volatility. I think about our distributors. I just know this is tough on them and that we need to be there. But I also know one of the reasons I left the traditional part of the business is no one is doing what we are doing. Certainly not then. Now they're doing it in the form of ETFs, but not actively managed. They're just throwing spaghetti at the wall and seeing which funds stick, whereas we're very holistic. This is all we do, disruptive innovation. We're going to, live and die on this. And, I think you want us to be, focused on this because there's so much happening. And I think when people see how quickly all of this takes off, we've started to see it with AI, but we're probably in a pause period with AI now, which many people are saying, oh, okay, what's going on?
In related developments, the U.S. Federal Reserve's fast-approaching interest rate announcement on September 18th has left Bitcoin traders unsure of the cryptocurrency's future price. Despite expectations that a rate decrease would increase Bitcoin's value, Bitfinex experts warn that it could result in a 20% decline in price. This is because shifting macroeconomic conditions could threaten the predicted benefits of lower interest rates. Falling interest rates make riskier assets like Bitcoin more appealing, while traditional assets like bonds and term deposits become less profitable. However, the current scenario is complicated, and traders are worried. Bitcoin's current price is roughly $57,000, down 2.6% in the last week. A 20% decline would take it to $46,000, a level last seen in February and regarded by some experts as a possible starting point for a bull run. Some analysts, including Marcus Thielen of 10x Research, believe that a decline to the low 40,000 is required for a bull market to commence. Others, such as Joe Consorti of Bitcoin Layer, see $60,000 as a consolidation point where long-term investors accumulate and hold. Meanwhile, crypto trader Dan Crypto Trades believes Bitcoin still struggles to break away from its bull market support zone. The uncertainty around the Fed's decision has made traders nervous, with Bitfinex calling it a challenging time for Bitcoin traders. Fed Chair Jerome Powell's dovish statements in August fueled hopes for a rate decrease, but the impact on Bitcoin's price remained uncertain. Traders are eager to see how the market will respond to the Fed's decision. Will Bitcoin's price fall or rise? Only time will tell. Meanwhile, traders should be careful and prepared for any situation. The cryptocurrency market's volatility means that values can move quickly, and traders must be prepared to react to shifting circumstances. As we conclude, what are your thoughts on this interview? What strategies do you use to navigate market volatility and balance risk in your investment portfolios? Please drop your thoughts in the comments below, share this video, and hit your thumbs on the like button. Thanks for watching. Don't forget to subscribe.